Today, we're going to be doing a deep dive
Oh, yeah.
into investment strategies, specifically how to avoid common mistakes
Yeah.
and pitfalls that can seriously hurt your returns.
Yeah, for sure.
And to help us with this deep dive, we're going to be looking at the insights of David Bonacea,
Okay.
who's a popular investor over on eToro.
Awesome.
And he's got some really interesting stuff to say, especially when you consider that something like 90% of investors
Whoa.
lose money.
Whoa, 90%.
Yeah.
That's a big number.
It's wild, right?
Yeah.
So clearly something's going wrong for a lot of people out there. So how can we avoid being part of that statistic?
Right.
So Bonacea has outlined like 5 major errors.
Okay.
5 fatal errors that investors make.
Right.
And we're going to kind of go through each of these
Great.
and talk about them today.
Sounds good.
So the first one is the lack of diversification.
Yeah, diversification. I mean, that's something that you hear all the time, but
Right? It's like, what does it even mean?
what does it mean and why is it so important?
Yeah. Like, what does it mean?
Like, okay, so imagine you're gonna invest in apples. Okay.
Right.
You could put all your money into one type of apple,
Okay.
hoping it's going to be like the best apple, right?
Yeah.
But what if that apple gets a disease? Or like suddenly everyone wants a different type of apple?
Right. All your eggs in one basket.
Exactly. You've lost everything.
Yeah, that basket tips over, you're in trouble.
Exactly. And so diversification, it's about spreading your investments across different things,
Okay.
like different asset classes. So, stocks, bonds, real estate, even things like gold.
Commodities.
Commodities, yeah.
Okay.
So you're not putting all your faith and all your capital into one single investment.
Gotcha. So you're not betting on just one horse.
Exactly.
In the race you're betting on, like
On the whole field.
the whole field, yeah.
Yeah.
That makes a lot of sense.
Yeah.
So Bonacea, he actually uses what he calls a 3-bucket approach.
No, just
So can you tell us a little about how he diversifies?
yeah. So he divides his investments into 3 main categories. The first is high growth stocks. These are the ones that have the potential for big returns, but they also come with, a higher risk.
Yeah.
The second bucket is stable bonds,
All right.
like TLT. That's an ETF.
Okay.
It's focused on long-term treasury bonds, and that provides more predictable returns.
Okay.
It kind of acts like a buffer when the market's going crazy.
So it's kind of like a safety net.
A safety net, yeah.
Okay.
Exactly. And then finally, he puts a little bit in gold through GLD, another ETF. And gold generally, kind of moves in the opposite direction of the stock market.
Oh, interesting.
So it adds like another layer of protection.
So it's kind of like a balanced meal, right? You got your protein, you got your carbs, and then you got a little dessert.
Exactly. Yeah, you got your little treat.
A little something sweet.
Yeah, and it makes sure that you're not, like you said, overexposed to any one area.
Yeah, that makes sense.
Yeah.
All right, so fatal error number 2.
Okay, number 2.
Is chasing trends.
Ooh, this is a big one.
I feel like this is such a tempting trap.
It is. It really is, especially like, with like 24/7 news and social media.
Yeah.
There's always some hot new thing.
Right. Yeah, you see it everywhere. You're like,
You feel like you're missing out.
yeah, FOMO.
Yeah, exactly.
Got to get in on that.
And what happens is people buy high and then they sell low, and that's the recipe for disaster.
You're doing it backwards.
You're doing it backwards, yeah.
Yeah.
It should be buy low, sell high, not the other way around.
Exactly. So we saw this with the whole meme stock thing
Yeah.
a couple years ago, where it was just like,
The frenzy.
yeah, and everybody's just throwing money at these companies that were like,
Based on hype.
yeah, purely on hype and not on like any fundamentals
Exactly.
of,
Actual businesses.
yeah, or, their actual financial health.
Right.
It's just like,
Oh, this is going up. Let's jump on board.
yeah,
Yeah, and a lot of people got burned
a lot of people got burned
when that bubble burst.
when the music stopped.
Yeah.
Yeah. So that's why Bonacea, he's like, you got to do your research.
Yeah.
Like before you invest in anything.
Okay.
You can't just jump on the bandwagon,
Yeah.
especially if it seems too good to be true.
Meh. Right, like if everybody's talking about it, maybe it's already
Yeah, the time has passed.
too late. Yeah.
Yeah.
So it's kind of like the difference between, buying a house just because it looks pretty from the outside,
Yeah.
or like actually having it inspected, getting the surveyor in there.
Checking the foundation.
Yeah, looking at the neighborhood.
Right, making sure it's not, in a flood zone.
Right, exactly.
Yeah, doing your due diligence.
Yeah.
Yeah.
So, all right, fatal error number 3.
Okay, number 3. This is an interesting one.
This one surprised me.
Yeah.
Not having an exit plan.
Yeah.
Like, why is it so important to plan your exit?
Well, it's all about taking emotions out of the equation.
When you're caught up, You're excited. You think you're going to make some money.
Right. Yeah.
It's easy to ride that wave even when it starts going down.
Yeah. Say, oh, it'll come back up.
Yeah, it'll come back up. It'll be fine.
Yeah.
But having a clear exit plan with like price targets and stop loss points,
Okay.
that helps you make rational decisions no matter what's happening.
Yeah, because the market doesn't care about your feelings.
The market does not care about your feelings.
So you've got to
They
be...
have to be rational.
Yeah, you got to be like, okay, if it hits this price, I'm out.
Exactly.
Even if like everybody's saying it's going to go higher.
Yeah. Don't listen to the hype.
On the flip side, like if it hits this price, which is,
Below what you bought it for.
too low, I got to cut my losses.
Got to cut your losses, yeah.
And get out.
Rip off the Band-Aid.
So Bonacea, he uses examples like TLT, which we talked about.
Yeah, the bond ETF.
Yeah, and GLD, the gold ETF, to show how he sets specific objectives for his investments. And he knows when he's going to sell, whether he's hit his profit target or is a stop loss.
Exactly.
So he's not just like riding the wave and hoping for the best.
Hoping and praying.
Yeah, he's like...
He's got a plan.
Yeah, it's almost like having a fire escape route.
Oh, I like that.
You hope you never have to use it.
You hope you never have to use it, but it's there.
But it's there just in case.
Just in case.
All right, so that's number 3.
Number 3.
What about number 4?
Number 4. Okay, so this one's a little more complex.
Okay.
It's ignoring technical and fundamental analysis.
Oh, boy. Okay, break this one down for us.
Okay, so imagine you're looking at a map of a city, right?
Right.
You could focus on just one little neighborhood, but you'd be missing the bigger picture.
Yeah.
Technical analysis, which is like studying charts and patterns. It's like zooming out to see the whole city.
Okay.
Identifying the trends and the areas that are growing.
Okay.
And fundamental analysis is like going into those neighborhoods.
Right.
And checking out, what's going on.
Yeah.
So if you're only looking at, a stock's performance over a few days or weeks, you're missing the big picture.
Right.
You need to zoom out and see what's been happening over months or even years.
Okay.
And that's where technical analysis comes in.
So you got to look at like the macro trends?
Exactly.
Okay.
Bonacea talks about using monthly charts to get that bigger picture view. But he doesn't stop there. He combines that with fundamental analysis.
Okay.
And that's where you look at a company's financial statements, you look at their earnings reports.
So you're looking at, is this a healthy business?
Exactly. Yeah. Is this a good business?
Or is it just like, built on hype?
Is it all smoke and mirrors?
Right.
And is it in a growing industry? Is it in a dying industry?
Yeah. What's the future look like?
Exactly. What's the long-term potential?
So it's kind of like, looking at the houses in a neighborhood,
Yeah.
making sure that they're well maintained.
Yeah. Are they taking care of the properties?
Right. And are there good schools nearby? Are there parks and shops?
Yeah. Is there a sense of community?
Right.
What's the vibe like?
Yeah. Yeah.
Exactly. You want to invest in a good neighborhood.
Yeah.
Right? Not a bad one.
All right. That makes a lot of sense.
Yeah.
So we come to the 5th and final fatal error.
This is the big one.
I think this might be the most challenging one
It might be.
to overcome.
Yeah.
Letting emotions rule your investment decisions.
Oh, the dreaded emotions.
Oh, man. This is something that I think everybody struggles with.
Everyone struggles with it. Yeah.
Because we all get scared, when we see our investments going down.
Yeah. Nobody likes to lose money.
Right. And we all get excited, when we see those gains.
Yeah. And then you want more and more and more.
Right. Yeah. It's like,
this is great.
the greed takes over.
Yeah.
But you got to be careful.
So how do we keep those emotions from like leading us off a cliff?
Well, Bonacea says, mastering your emotions has been key to his success.
Okay.
And it's a constant battle.
Right.
But fear, fear makes people sell their investments at the first sign of trouble.
Right. They panic.
Yeah.
And then they end up realizing a loss that maybe they could have avoided.
Exactly, if they had just stayed calm.
Right.
And then on the other hand, greed pushes us to chase those risky investments.
Right. Those get-rich-quick schemes.
Yeah, we think, this is going to be the next big thing.
Yeah.
And we ignore all the warning signs.
Right.
We're blinded by the potential riches.
So it's like that feeling you get when you're playing poker.
Oh, yeah.
And you've got like a decent hand.
Yeah.
But then you see somebody else betting big.
Uh-oh.
And you're like, oh, man, maybe I should go all in.
Even though deep down it's probably not a good idea.
Right. It's not the smart move.
Yeah.
Yeah.
So you guys stay calm, rational, disciplined.
Okay.
Have a plan and stick to it.
So you're saying like don't just react to what's happening in the market?
Don't react emotionally.
Yeah.
Have a strategy.
Right.
Set your goals and stick to your plan.
Yeah. And sometimes it's like You got to just turn off the news.
Yeah, turn off the noise of that financial news. It could just be overwhelming.
It's just noise.
Yeah, it's just noise.
Yeah.
And it gets you all worked up.
Yeah, and it makes you make bad decisions.
Exactly. So sometimes you just got to step back.
Yeah.
Take a deep breath.
And remember why you invested in the first place.
Yeah. What are your long-term goals?
Right.
Don't get caught up in the short-term fluctuations.
All right. So to recap, we've covered the 5 fatal errors.
The 5 deadly sins of investing.
All right. So no diversification.
Right.
Chasing trends. No exit plan. Ignoring analysis, both technical and fundamental.
Right.
And letting emotions rule.
The big one.
Yeah. So avoiding these pitfalls, it really requires like a mindset shift.
It does.
It's moving away from those impulsive decisions based on, hype or fear.
You got to be disciplined.
Yeah, and embracing a more disciplined and informed approach. Informed and rational.
Yeah, so Bernanke's insights are really like a practical roadmap.
Yeah.
To navigate this crazy world.
It's a jungle out there.
Yeah, it is.
Yeah.
So I guess as our listeners are thinking about their own approach, they should be asking themselves am
I spreading my risk?
Am I diversifying?
Am I chasing the latest trends?
Yeah.
Or am I actually looking for value?
Yeah.
And am I letting my emotions drive the car?
Yeah. Am I in control?
Or am I just a passenger?
That's a great way to put it.
Yeah.
Yeah. Those are some really good questions to ask.
Some good food for thought.
Yeah, food for thought as you guys continue on your investment journeys.
Yeah.
So remember, knowledge is power.
It is.
By learning from, the mistakes of others.
Yeah, stand on the shoulders of giants.
You can increase your chances of success in the markets.
Absolutely.
So keep learning, keep growing, and we'll see you next time.
See you later.
All right. That's it for this episode.
Thanks for listening, everybody.
Thanks for joining us.
See you next time.
Bye.